So I recently filmed, and hopefully you caught a video that I shot around what's an economic phenomenon called stagflation. Stagflation was broken down, detailed in that video, explained how it plays out in the economy, how it even gets there, and how to navigate, what to expect from it if we get there, and how to navigate it to the best of your ability if we get there. This video is taking a step or so back, and how the Federal Reserve, unfortunately, has to make you poor and make your economic circumstances more challenging in order to avoid stagflation, the lesser of two evils. We're covering that in this video. This is JP from Blueprint for Prosperity. We're gonna get right into it. So the Federal Reserve has to exercise a monetary policy called quantitative tightening. That basically means that the Federal Reserve has to pull money and liquidity out of the financial markets to basically combat an overheating economy, which is inflation. This is something the Federal Reserve absolutely has to do, and they have to do it effectively and in a timely manner because this naturally slows down the economy. Slowing down of the economy means that unemployment picks up, liquidity dries up, the investment markets typically suffer. And this all cycles around. People have less money. They have less access to capital. They have less money to spend. Wage growth stagnates. It's just, and all of it just kind of just goes in unison with each other. They have to let this happen, and they have to let it happen fast, because if they don't do it efficiently enough, then they don't get inflation under control. So they're still tight in the economy. But then if they do it in a lethargic way, or they're half-stepping in the process of doing so, then they're going to allow inflation to stay high while slowing down the economy. That is the manifestation of stagflation. For you, I want to break down the quantitative tightening process, why they need to go this route, as I just kind of explained to you already, but more importantly, how you can navigate around it to still survive and possibly thrive economically until this cycle is over, in hopes that the Federal Reserve is able to get the job done in time and we can avoid the worst case scenario, which is stagflation. With quantitative tightening, the Federal Reserve has already started a process going on a year straight of restricting liquidity in the marketplace by raising the federal funds rate. The Federal Reserve is the core to money supply in our economy. So whenever the Federal Reserve raises their rates, that basically is where banks are getting their money. And where do we get our money as individuals, consumers, and small business owners? The banks. So the Federal Reserve starts that supply chain issue of liquidity by tightening up in the system, making it more expensive and harder for banks to get access to that money, or at least pay a higher premium, which again puts less money in the system or pulls money out of the system. And if banks have less access to capital, then their business model has to mold around the Federal Reserve's monetary policy. So if the Federal Reserve is making it harder to get capital, banks in turn pretty much have to do the same thing because of supply and demand. So when that happens, as I kind of explained already, there's this natural progression of economic circumstances that plays out. Companies have less access to capital. They're also dealing with the fact that consumers have less access to capital. So they're spending less money. If they're spending less money, then companies, profits are slowing down or coming to a halt or thinning. And if that happens, then the first thing they do to start cutting costs and trying to balance off and lean out is get rid of employees. When that happens, you have unemployment go up. Unemployment goes up. People have less money to spend, and the cycle just keeps going on, if that makes sense. There's less investment in the marketplace. The marketplace becomes a darker place to invest in many places, because again, most of this is dependent on consumerism. It's dependent on businesses growing. So if all of that is not happening, then the stock market, subsequently job market, stock market, and eventually the real estate market catches the brunt of all of that. So the Federal Reserve actually actively has to make you poor, has to pull liquidity out of the system and make it harder for you to borrow. They have to make it, harder for you to keep your job, or depending on what field you're in, they have to even in some cases put people at risk of losing their jobs intentionally in order to save the broader economy as a whole. Because again, as bad as what I just described sounds, stagflation is significantly worse. So fighting one of these demons at a time is way better than fighting both demons at the same time, that being inflation and a slowing or downturning economy. So what does that look like for you? How do you navigate that? What type of financial practices, what type of strategies do you need to put in place to mitigate and combat some of this? Some of the common sense things you need to do is minimize your risk when it comes to spending and investing. If you're a W-2 employee, or even if you're a freelancer or gig worker, or if you're a business owner, you need to hold on to what's working for you. If it's a W-2 job, you need to hold on to that. This is not the time to be skirting around, quitting arbitrarily and trying to find another job. If you're a freelancer, you need to double down on whatever work is available for you. Lean into what's working for you. This is not the time to try to branch out and take risk or try something different. You need to be going with what works for you. Wherever your income source is, you need it to be stable as possible, is where I'm going with that. The next thing that you need to start exercising, once you hopefully have that under control and you're not one of these people that hopefully experiences unemployment or some significant gap in your income, is to stabilize cash reserves. Not just from the peace of mind perspective, but for the next strategy that I'm going to get into and how you can use those cash reserves to help put some extra money in your pocket and to combat the, tightening you're experiencing, the lack of liquidity, and, even a loss of purchasing power. Because meanwhile, inflation is still, even though the Federal Reserve's winning that battle, inflation is still high. So you're still losing purchasing power. So you have to keep up with all of that at one time. So you want to build up your cash reserves, and you want to get to the point where it's at a reasonable spot. If I'm not necessarily making an argument that you need to be starving yourself to save $1, but you do want to get to the point where you have a decent lump sum of cash based on your financial position. That's very subjective, person to person. So I'm not really going to throw numbers out per se. That having been said, you've stabilized your income, built up a reasonable cash reserves / emergency savings. The next thing you want to do is find financial strategies and tactics that are accessible to you, that allow you to retain more of your money and earn extra money from various different financial strategies within relationship banking. One of these strategies that I tout very heavily on this channel is credit card optimization. Optimizing the use of credit cards. Basically laid out, you're finding the best credit cards that will give you the most value on your highest spending. That's the simplest breakdown I can give you if you're new to it. This is a process where you find out where you spend the most money, and the marketplace, the credit card marketplace, is packed with cards for almost every spend category that's common to the US consumer. That's exactly how they make their money. So they're gonna make products that fit your needs. There's one out there somewhere, at least one. You don't need to be an enthusiast or an optimizer to the point where you're walking around with 20 and 30 credit cards at a time. Those guys are phenomenal magicians, and I salute what they do. I say it all the time, but to optimize this game, you honestly can have anywhere from about 2 to 4 or 5 credit cards in your wallet or purse and do really well for yourself in the strategy. You want at least 2 cards that'll cover your 2 highest spend categories possible. So that's going to usually be something along the lines of transportation and food related, gas, groceries, transportation costs, auto insurance, car, well, not necessarily car note, but, things of that nature that you can put on a credit card realistically. Even rent payments now with the new built MasterCard that's out, covering rent payments is a phenomenal option because that's housing, which is the vast majority of Americans' top spend category is housing. You can't put a mortgage payment, but you can put rent on a built MasterCard. Finding optimizing cards in your existing banking relationships ideally, but if you're comfortable with it, you can start to build out banking relationships and lending relationships with other institutions that offer credit cards that match your spending better. So you do your best to find those high spend categories in your budget, and you find credit cards that will give you 2, 3, 4, 5% on those. Great welcome bonuses. You're building credit at the same time. The reason monetarily this works for you at a time like this, where the Federal Reserve is pulling money out of your pocket in ways and making it harder for you to, build your wealth up or build and maintain your finances, is because you're taking areas you're already spending the bulk of your money, which tends for most of us to be thousands of dollars a year, and getting back hundreds of dollars, tens to hundreds of dollars. And in some cases, if you do it really well, thousands of dollars back a year. You don't have to do anything fancy. You're hitting areas that you already spend money. And this is an accessible strategy. The vast majority of us should be qualified for credit cards. And once you do a little bit of homework, the marketing is out there, the resources are out there, especially if you already have banking relationships, with the vast majority of you should have. It's a matter of you going online or stepping into your local institution and just researching the credit cards they have available. And again, just find the ones that give you the most value for most of your spend. You don't have to be a rocket scientist at this, but you want to start recouping some of that value back, because that's 2, 3, 4, 5%. That's fighting the 4, 5, 3, 4, 5, 6% of inflation or purchasing power loss you're experiencing in a year. You're literally offsetting that. The next strategy coupled along with that, once you have access to cash savings, $5, $10, $15, $25,000, you get to that range, you can start chasing banking deposit account incentives that are out there. There are promotions and incentives that are all over the place with banks. If you move $5, $10, $15, $25, plus $1,000 with them all the way up the ladder, they will incentivize you with hundreds, sometimes thousands of dollars in promotions, simply for sitting the money in there. You don't even need to jump through many hoops. In some cases, you have a few spend requirements and maybe you need to set up a direct deposit. It kind of depends. But in many cases, a lot of banks are just looking for the deposits. They're just literally looking for the deposits. So you can open a savings with them. Sometimes there's CD specials, IRA specials. You can sit $10,000, $15,000, $20,000 in these accounts. It's still your money. In some cases, even still liquid, and get $200, $300, $400, $500 just for doing that. And the money only needs to stay for about 90 days to 6 months. So you can do this anywhere from 2 to 4 times a year. Even if it's like $250 or $300, it can be an extra $1,000, $1,200 in a year for doing absolutely nothing, but moving your money around from one institution to the next strategically. These are the types of financial tactics and strategies that can keep more money in your pocket or put more money in your pocket without you having to take significant risk or obstruct your finances to do so. These are all practices you should have anyway. You should be stabilizing your income, building out your credit profile, and building up your cash reserves and putting it in the best place with the most earnings anyway. Deposit products are paying reasonably well. So if you can get one of these high yield savings or CD specials where they'll pay you $200, $300, $400, $500 and give you 2, 3, 4, 5% on that money for the duration it's in there, you're winning. You are winning, my friend. So I wanted to bring this to you because the Federal Reserve isn't intentionally gonna be making you poorer actively. They have been for over a year now with their monetary policy, because they have to save us in the longer term. In the meantime, these are the type of strategies you need to put in place to combat, stabilize, and grow in these economic circumstances until things turn over and money is freer in the system, liquidity is freer in the system, and the economy is doing well again. So I appreciate you tuning in. Drop your comments and questions down below. There are also links in the description of this video that are referral links. I have credit card referral links from American Express, Capital One, some of my direct referral links that you can support this channel and yourself by getting a great welcome bonus or referral incentive yourself without having to spend a dime. So check those links out in the description below. Other than that, to all my pioneers out there, I enjoy bringing you this content. Thank you for tuning in. I want you to stay focused, stay in motion. I'll see y'all soon.
This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.